Welcome to Technical Analysis Essentials. In this session, we'll explore the basics of technical analysis, focusing on three key tools: moving averages, relative strength index, and MACD. Technical analysis helps traders understand market trends and make informed decisions based on historical price data. By the end of this session, you'll have a solid understanding of these tools and how to use them effectively in your trading strategy. What is a moving average? A moving average smooths out price data to highlight trends over time. Two types commonly used: simple moving average, the average closing price over a specific period; exponential moving average, similar to a simple moving average but gives more weight to recent prices. How to use moving averages. Trend identification. If the price is above the moving average, the market is in an uptrend; below it, a downtrend. Crossovers. When a short-term moving average crosses above a long-term moving average, it signals a potential buy. When it crosses below, it signals a potential sell. Practical example. Imagine a stock price consistently trading above its 50-day exponential moving average. This indicates a strong uptrend, suggesting potential buying opportunities on pullbacks. What is RSI? RSI is a momentum oscillator that measures the speed and change of price movements. It ranges from 0 to 100 and is used to identify overbought or oversold conditions. How to use RSI. Overbought. RSI above 70 indicates that the asset may be overbought, suggesting a potential reversal or pullback. Oversold. RSI below 30 indicates that the asset may be oversold, suggesting a potential bounce or upward reversal. Divergences. If the price makes a higher high, but RSI makes a lower high, it signals a bearish divergence, indicating a potential price drop. If the price makes a lower low,